Right now, most Canadians believe crypto is still a gray zone, something the CRA knows about in theory, but can't really track in practice. That belief officially became dangerous on January 1st, 2026, because as of this year, every registered crypto platform in Canada is required by law to collect and report your full transaction history to the federal government. The first official reports land in 2027. The question is, are your records ready? I'm your crypto compass. Let's get your bearings. In this video, I'm going to walk you through exactly what Canada's new crypto reporting framework means for you as a beginner. What gets reported, what actually triggers a tax obligation, and how to make sure you're using the right platform heading into 2027. And at the end, I'll give you a simple 5-step checklist to get your records in order before that first CRA deadline arrives. Stick around, because the most common thing I hear from Canadian crypto holders is, "I didn't know that." After today, you will. The framework that changed everything is called CARF, the Crypto Asset Reporting Framework. It was developed by the OECD, the international organization of 38 developed economies that coordinates global tax rules and financial standards. Canada adopted CARF, and it came into force on January 1st, 2026. Here's what CARF does in plain language. Any crypto trading platform operating in Canada, whether it's Coinbase Canada, Newton, Kraken, BitBuy, or anyone else, is now legally required to collect detailed information about your trades and report that information directly to the Canada Revenue Agency. We're not talking about vague summaries. We're talking about your full legal name, your tax identification number, your country of residence, and a complete record of every transaction you made, the type of transaction, the date, the amount in both crypto and Canadian dollars, and the specific asset involved. And here's the part that surprises most people. Platforms are required to do this even if you have never filed a crypto-related tax return in your life. The CRA no longer needs you to self-report. The platforms are doing it for them. Now, just because your platform reports your trades to the CRA does not automatically mean you owe tax. Let me explain what actually triggers a tax obligation, because this is where most beginners get confused. And it'll be the difference between a clean 2027 and a stressful one. In the next section, I'll walk you through every type of crypto activity that does and doesn't create a tax event in Canada. Some of them will surprise you. The CRA's position on crypto is clear and hasn't changed, but a lot of Canadians still don't know it. Crypto is treated as a commodity in Canada, not a currency, and that means every time you dispose of it, there is a potential taxable event. What counts as disposing of crypto? Selling crypto for Canadian dollars. That's the obvious one. But also, trading one cryptocurrency for another, using crypto to pay for a product or service, and gifting crypto to someone other than a spouse. What is not a taxable event? Simply buying crypto and holding it. Moving crypto between your own wallets. Receiving crypto as a gift from a spouse. Those don't trigger a tax obligation on their own. When you do have a taxable disposition, the CRA taxes the capital gain. If you bought one Bitcoin at CAD $50,000 and later sold it at CAD $100,000, you have a $50,000 capital gain. Under current rules, 50% of that gain, $25,000, is included in your taxable income for that year. Here's the part that matters right now. Before 2026, it was relatively easy to underreport crypto gains because platforms weren't required to share data with the CRA. That era is over. Under CARF, the CRA will have access to the same transaction history your platform holds. If your tax return doesn't match what the platform reported, that is a problem. Which brings me to the most important thing I want you to take away from this video, and I'll get to the exact steps in a few minutes. But first, let me explain why the platform you're using right now matters more than you might think. Most Canadians are using a platform that already holds everything the CRA will ask for. The question is whether you're using one that puts you on the right side of that conversation. And I'll explain the difference next. Not every platform offering crypto services to Canadians is subject to CARF in the same way. The ones that matter for this conversation are the platforms registered with FINTRAC, Canada's financial intelligence unit, and approved under Canadian securities law. Fully registered Canadian platforms, the ones the OSC has approved as restricted dealers or granted exemptive relief to, are required to comply with CARF. They already have your KYC information. That's your Know Your Customer ID verification, and your full transaction history. Under CARF, they'll report that to the CRA starting with your 2026 activity, with the first submission due in early 2027. Here's the upside. If you're already on a registered platform, you have a clean, verifiable paper trail. The same data your platform sends to the CRA is the data you'll use to prepare your taxes. There's no discrepancy risk. You and the CRA are working from the same source of truth. The risk profile is very different if you're using an offshore exchange that isn't registered in Canada. Those platforms aren't directly subject to CARF, but Canadian residents are legally required to report all crypto gains regardless of where they traded. And with 38 OECD countries implementing equivalent frameworks internationally, the window for offshore opacity is closing fast. FINTRAC has already canceled over 50 unregistered money service businesses in Canada in 2026 alone. If you're currently using a registered Canadian platform, the news here is actually good. You already have the records you need. In the final section, I'm going to give you a concrete 5-step checklist. Things you can do this week to make sure your records are clean before the 2027 window opens. Don't skip this part if this is the kind of practical Canadian crypto content you find useful. Without the hype, without the price predictions, hitting subscribe means you'll catch every video I release. I cover Canadian crypto regulation and beginner guides every week, and this is exactly the stuff most channels skip over. Alright, here's your 5-step checklist. Most of these take less than 10 minutes. Step 1. Log into every crypto platform you've ever used and download your complete transaction history. Do this now while the data is still accessible. Platforms change, merge, or shut down, and historical records are not always preserved after the fact. Step 2. For each transaction, note the date, the amount of crypto, and the value in Canadian dollars at the time of the trade, not today's price. The CRA cares about what it was worth when you disposed of it, not what it's worth now. Step 3. If you've ever moved crypto between platforms, sent coins to a hardware wallet, or used crypto to pay for anything, make sure you have records for all of it. Those can be taxable events, even if no platform reported them directly. Step 4. If you're spread across multiple exchanges, consider consolidating to one registered Canadian platform. One clean transaction history is far easier to reconcile at tax time than 5 different exchange exports. Step 5. Find a Canadian accountant who has experience with crypto before year-end. This isn't expensive. Many firms now offer short crypto consultations, and it's the single highest return action you can take before the 2027 reporting window opens. If you're looking for a registered Canadian platform to start with or consolidate to, Coinbase Canada is what I cover on this channel. It's OSC-registered, accepts Interake deposits in CAD, and the transaction history export is exactly the format a Canadian accountant needs to work with. Link in the description. So, what did we cover today? CARF is real. It started January 1st, 2026, and it means every major registered crypto platform in Canada is now reporting your transactions to the CRA. The first reports land in 2027. That's not a threat for Canadians using registered platforms and keeping clean records. It's actually an advantage. You have a built-in compliance paper trail that unregistered offshore users don't. The one thing I hope you take from this: crypto is not a gray zone in Canada anymore. And the good news is, navigating it correctly is not complicated. You've already started by watching this. If you found this useful, subscribe and hit the bell. I release a new Canadian crypto video every week. And share this with someone who's been putting off getting their records together. you might just save them from a very unpleasant conversation with the CRA in 2027. What's your biggest question about crypto taxes in Canada? Drop it in the comments. I read every single one.